Welcome back. Now we'll look at where markets ended the week as the Iran conflict pushed oil prices closer to $100 a barrel. Wholesale prices came in hotter than expected this week, and the Federal Reserve held interest rates steady. Fed Chief Jay Powell citing concerns over higher inflation, lower labor demand, and Middle East uncertainty for not cutting rates again. Meanwhile, the White House is not backing down from the DOJ investigation into the chairman. And Powell said he's staying put until the end of the probe and until his successor is in place. But confirmation hearings for Kevin Warsh so far are on hold. Joining me now to discuss all of this is Federal Reserve Board Governor and Vice Chair for Supervision, Michelle Bowman. Michelle Bowman, great to have you. Thank you so much for being here this weekend.
It's great to be here with you.
So the Fed did not cut rates this week, but you still intend to cut rates or support rate cuts this year.
I have 3 cuts written into my forecast for this year, yes. And I supported the decision to hold at the FOMC meeting this week. I do still see some fragility in the labor market, but we're also seeing a little bit of stalling in the inflation rate. So I'd like to see some more progress on lowering inflation.
And I'm sure that the spike in oil prices is going to show through when we start getting all the earnings news, higher costs for corporate America. Are you expecting this to be temporary, as the president has talked about? What is your stance on inflation and, importantly, economic growth this year?
So I still see that we'll have strong economic growth, just as we had last year. We'll see a bounce back in the first quarter from the government shutdown in the fourth quarter of last year. I think right now it's too soon to tell what the impact of the Iran conflict is going to be on the economy and economic activity. If that extends for a longer period, then by the April meeting, I expect that I'll be considering what those longer-term impacts might be in my economic forecast.
Tell me how you're thinking about jobs these days, Mickey, because we're in a new day in terms of artificial intelligence. I mean, just recently you saw Block say, oh, I'm cutting 40% of the workers in my company because I have found AI tools to replace humans. What's your take on a structural change, I believe, is underway in the jobs market? And how do you see job creation this year?
So to address AI in particular, I'm not hearing from my business contacts that they have plans to lay off workers or to reduce their hiring as a result of AI. What they're thinking of it as initially is as a productivity tool for their existing workforce. What we're hearing about is uncertainty as a reason why businesses are not hiring. We are seeing a very low hire, low fire job market at this point, which is why I've pointed out since last summer that there's some fragility in the labor market. It does seem to be that they're pointing to uncertainty about holding back on hiring, but I expect, and as they share with me, that as uncertainty lessens and there is more certainty, that they will begin to hire again.
Okay, because I guess people want to understand where the jobs are and who is hiring, and I think things are shifting because, you know, white-collar jobs are seeing maybe different opportunities as opposed to blue-collar jobs, like the president talks all about. We need more engineers, we need electricians, we need trade schools. Is that the way you see it in terms of job growth?
So what we've seen with the job data that we've been receiving is that most of that hiring has been in healthcare, and it's really nursing home and home healthcare in particular. So these are some things that we're seeing as a trend, but I agree with you, we're sending too many people to college that probably should be learning a skilled trade. You can make a great living as a skilled tradesman and owning your own business. So I think we need to think about diversifying our workforce a little bit more and encouraging people to go to trade schools.
All right, let me move on to the proposals that you released in terms of oversight of the banking sector. And wow, what a difference from your predecessor in terms of what we're talking about here. First, talk to us about the goals. You're trying to get more money into the economy so that money can be used for credit and for lending. Walk us through your goals with these proposals and what they are.
So when I took on this job last June, my main goal is to modernize the regulatory framework so that we can get banks back into the lending business to support the U.S. economy. So with this particular proposal that we voted on last week, and which was broadly supported, by the way, I think it's really a great testament to the work that we can do together on our board to have broad support for capital proposals. it's meant to get banks back into the lending business, banks of all sizes, to back into credit cards, business lending, small business lending, mortgage business, all of these things that since the financial crisis, we pushed that activity out of the banking system and more into the non-bank framework.
Yeah.
So this is designed to encourage and not disincentivize providing a path back into those traditional lending activities.
Because we know if a bank is holding more and more capital, that's one less dollar that they're putting into the market, into the economy where a small business might need that lending.
Absolutely.
You've got new implementation of Basel. You've got the GSIB, meaning the Global Systemically Important Bank Surcharge Reform, and standardized approach to risk-weighted assets. What does that mean?
What it does is it right sizes the capital requirements for different activities to incentivize our financial system, our banking system, to get back into the business of supporting our businesses and communities.
Yeah, because obviously if a bank has exotic strategies and options programs and they're dealing with international economies across the world, that's different than a small vanilla bank.
Absolutely.
That we just want lending.
We should treat them based on risk. That's exactly right. Those activities should be scaled by risk.
Exactly. Treat them from their risk profile. So after the regional bank failures that we've seen last year, what is still vulnerable in the system right now? Where are the risks?
So what we're looking at is improving our ability to supervise financial institutions so that we can identify those issues earlier and ensure that we can try to mitigate any potential bank failures. We're focusing on the financial risks that a bank may have or its vulnerabilities and ensuring that we're addressing those and allowing a bank to mitigate those circumstances that lead to that.
So do you worry about private credit, for example? Are you worried about an AI bubble? Are you worried about the bond markets and leverage in the bond market?
So we look at a wide range of banking activities to ensure that our supervisors are appropriately reviewing and working with the banks to identify those activities, the degree to which they're engaged, and how much they influence the financial system and its stability.
By the way, Mickey, were you surprised when you heard Jay Powell say, "I have no plans to leave"?
Well, I'll let Jay's statement speak for itself.
Okay, we will leave it there. It's great to have you this weekend.
Thank you so much.